Hello everyone and welcome. Number of retail investors have benefited tremendously from this historic bull run in tech and semiconductors and even Korean Kospi index. But thing is, also, this historic bull run where it pertains to S&P 500 is happening on fairly short breath, which means the volume in the market is not extraordinary. So now, regardless of whether or not you had a chance to benefit from this historical rally, the setup is still playable, and I'm happy to share some ideas on how you can trade it. So now, with S&P sitting at over 7,500 points, and understanding that you could effectively see, even though some further progress, maybe even to 8,000 points, possibly even to 10,000 points, but it's going to come to the end. This happens in 100% of cases for any parabolic move, and it has only been very few times that S&P has been growing consistently for 9 straight weeks, as it has been doing so far. There's only one precedent, historically speaking, where S&P 500 been growing consistently for 11 straight weeks, and the absolute maximum is 12 straight weeks of growth. What does it tell you? It's a question of time when the trend is going to invert, not if. As in any trend, you might be looking for a catalyst. Catalyst-wise, there are several things that could trigger. So, for example, June 16 to 17, there will be, for the first time ever, Kevin Walsh holding press conference as a part of a FOMC meeting. How markets will react and what is he going to say, that is a very open question. But ultimately, markets will be looking for any sort of perspective as to what will be his policy. And even though with a very high chance of probability there will be no actual move or outcome on the rates, the way he will carry out the meeting and what he's going to say and how he's going to present himself is going to define a lot in upcoming market trends. Then possibly we are going to have a G7 summit, which in a number of cases could also act like a catalyst. And then we are going to have midterm elections. Historically speaking, around midterm elections, markets react negatively, which again gives plenty of opportunity to estimate and think over the time when the trend we have been observing so far in S&P can invert. What does it mean and how to trade it? As of last week ending, you can notice that literally everyone is super bullish on the market. And for example, put options have become incredibly cheap. Now, with an understanding that market most probably is going to invert, it's not going to go to the moon forever, you can bet within a certain time frame on inversion. So let's consider put options. Put option effectively allows you to buy at your discretion, but not an obligation, a certain asset, in that case we're talking about S&P 500, at a certain price level, strike price. Traditionally, when you open a put option, you would like to give yourself a freedom of time. That's why, for example, you don't want necessarily, unless you're seasoned and very confident investor, buy, let's say, a put for the next 2 weeks or 3 weeks or 4 weeks, or in a number of cases you can even do 0 days to expiration. But in the case you want to give yourself extra flexibility and a peace of mind, maybe you want to buy put options for December, November, which makes sense, or in a number of cases even January. As of right now, they are very cheap because there is a huge bull run and market is not really pricing in a downturn. And then once you have bought your put options, you can do several things with them. Option number one, market does not go down. In that case, you can just wait and have your puts expired. And in that case, you are just losing the commission, the premium you paid for those puts. But since they're cheap, it's fairly insignificant investment to risk, I would put it this way. Option number two is, and let's assume we are having some downturn in economy and more importantly in the market. As the put expiry date approaches but has not happened yet, you can sell those puts for an increased premium, just as you would sell any other sort of long position. And option number three is that you can wait until their expiration date and they will be cash settled, which also gives you enough of opportunities to effectively benefit from the price difference of your strike and the current one at the time. And then taking into consideration that how much usually you can make of it, I would say it's fairly a decent trade. Additionally, you can play the same circumstances slightly differently. For example, we have a FOMC meeting or we have midterm elections and the market goes down. Market goes down, you buy the dip. Sooner or later, it's going to uninvert. The market is going to rebalance itself and go back to current or substantially higher than the current levels. I hope you found it interesting and educational. I'll see you next time.